Hi guys, it's Rash here from the agency. At the agency we work for you. Today I have a special guest. It's Marvin from Liquid Tax, the principal of Liquid Tax, a registered tax accountant. We would like to welcome him today. Marvin, welcome.
Thanks, Rash. Nice to meet you.
Thanks, Marvin. Today we were hoping you could give us some advice on how we could watch out with the Australian Tax Office to make sure that when we're doing our claims, we can actually make sure we're not making mistakes with them so that we don't turn into some issues down the track. And also we've got some good news for us down at the end of this discussion with an offer to my clients that would also be amazing and well appreciated.
Absolutely, Rash. It's a great time. And I guess firstly, just want to mention that what we're going to discuss today is really very high level general, and obviously consult a tax agent before acting on it. So, but I would really love to just talk about 10 common rental property kind of mistakes within your tax returns that many people get wrong, certainly when doing it themselves and occasionally even with some agents. So I guess firstly is to do with apportioning your rental expenses. In a lot of cases, you know, if you have a private use aspect to your property, you may need to just, you know, apportion some part of the deduction for that private use. Certainly for interest as well. Sometimes you get a loan that might cover the purchase of a boat or a car or a caravan at the same time as your house. So we just need to do some apportionments to make sure that we're only claiming the relevant amounts relating to the property.
So when you say that, you mean the actual interest payments for the property, but any extra expenses for personal items are not covered there?
That's correct, yes. So we'd apportion that interest claim, definitely, yes. So another big one, and I've certainly had clients get reviewed for this particular one by the ATO, it's to make sure that the property is actually genuinely available for rent. So in other words, it's been marketed at correct rates, reasonable terms and all that sort of thing. So, you know, because some people might have a property that they say is available for rent, they may put up the rent price at such a ridiculous amount that it'll never get rented because they don't really want it to be rented out. So from an ATO perspective, those properties aren't really available. So if you're trying to be well above the market or not advertise the property, then in theory, you can't claim rental deductions in your tax return either.
Wow, that's amazing. I'd never even considered that. So you have to genuinely be on the market to rent it out in order to claim the deductions as well.
Yeah, absolutely, absolutely. So a third one, another good one is getting your initial repairs and capital improvements right. So sometimes, you know, we've all experienced that you buy a property perhaps cheaper than market because it needed work to be done for various reasons. Perhaps it needed a new roof, a new fence, hot water system or something. So those initial amounts that you spend on your rental property, they're usually capitalized, they're not deductible. So it's more so if you have a repair. So the hot water system's a good one to use as an example. If you had a situation where you purchased it and the hot water system wasn't working and you replaced it straight away before renting it out, that wouldn't be deductible. Whereas if something went wrong with the system after renting it out and maybe it just needed a new part to be replaced, then that would be a deductible expense then, but not until after it was rented.
That would be quite common when people actually buy investment properties and do all the work and then come to you and say, can I deduct this? Are those deductions for when they sell it instead?
That's correct. Yes, they add to the cost base of the property, and in some cases too, it could be depreciable depending on the particular item of expense. But certainly keep a record of everything, and that would definitely be something we can talk about at the disposal time. Now, borrowing expenses, most of us have to get loans for our properties. So anything under $100 in terms of getting those loans set up, which is probably quite rare, are deductible up front. If it costs more than 100, then generally we have to claim it over a 5-year period. So that's something else that people get wrong. They sit there and claim all their borrowing fees up front, and we have to portion those out.
What are these fees, and what may they be? For example,
so it's usually the bank charges. Like when you go out to the bank, you get financing. They might charge you a administration fee of $500 or $600. That's quite think common in the industry, and those kind of fees, and sometimes even valuations. If it's commercial property, you'll have to pay for those. So those are the kind of like essentially borrowing costs, which we can claim at a later point over time, so over 5 years rather than upfront.
Okay, excellent.
Claiming purchasing costs is another common mistake. So things like stamp duty is the one that comes to mind that's usually done wrong, is that clients will then include that as a deduction on their property. So those things, once again, as discussed, we're similar to the assets and repairs. They just add to the cost of the property on sale.
Excellent.
Now, we've touched on this briefly with the claiming interest on your loan at the start. So once again, it's all got to do with the apportionments to make sure that the money that you borrowed relates purely to the property that you've purchased. Another common mistake as well, sometimes people pay off their loans on the rental property and then later refinance it or use it as equity for a purchase of another property, maybe their own main residence. In those situations, unfortunately, the interest is not deductible because it doesn't relate to the actual property. So there's some planning around that as to how we can, in strategy, and it's something that I'm happy to discuss and go into further details on a specific basis. Yeah. Okay,
that's an interesting one. If you pay off your investment property to buy a home for yourself, then that loan's then not deductible because your investment property is security on your home loan, basically.
No, sorry. I might not have explained myself there clearly. So basically, if you've had a loan for an investment property, and let's say you're very fortunate and came into some money and you managed to pay down that loan, at a later point, you then decide you want to buy a more expensive property for yourself, perhaps. And so the common mistake is people will then redraw their loan on their investment property, which got paid down, and then think that they can claim that interest. So essentially, once it's been paid off, we can't resurrect that debt for that particular property, because as far as the ATO are concerned, it's essentially a debt that's been fully repaid and there's no more liability. So if you redraw that money, unless you're putting it back into the property for, let's say, a renovation or an extension, it doesn't really count. So if you use that money to buy that boat or caravan or another main residence for yourself, then those interest charges relate to that purpose. And certainly if it was used to purchase another rental property, then it would be deductible, but against the new rental property as opposed to that existing one.
Okay.
So it all comes down to purpose and use of finances as to where you claim the deductions. So a lot of your construction costs as well for building and extensions, they can be depreciated over time. So, that's another common mistakes. People might do a substantial renovation and try to claim that in their returns. Unfortunately, they're more capitalised, and, we can help them out and work out the best way. So whether it's depreciation or special building write-offs, but there are deductions for it, but unfortunately not all up front.
Okay.
All right, so I think now we're up to number 9 of our top 10, and it's basically record keeping. So we just got to make sure we document everything, have receipts for payments, avoid getting tradies in for cash, because obviously you won't have receipts for those and we won't be able to claim deductions for the works that they performed, repairs. So always make sure that we are insisting on the receipt, and then we can then claim the deduction for it.
Yep.
Now, number 10 has to do with the final point. I guess you've had your property for a while and then you've decided it's time to move on and you've sold the property. So there are capital gains tax issues around that. Some of them can be quite complex, especially in the situations where it may have been your main residence at some point in the early days perhaps, and then later on you've then decided you're going to rent it out and then down the track sell it. So we can definitely help you out there. So the critical things to always keep in mind are the dates of when you sold your property and when you moved out and so on. So we'll get all that information from you and then calculate the best tax position we can.
Okay.
So that's the top 10, I guess, common mistakes that people make on the rental property schedules. But definitely happy to help out to any Team Rash clients too. If they want to reach out, we're happy to answer any questions for them.
Sure. Thanks, Marvin. And how has things changed in terms of this year's tax returns with COVID and people working from home? Obviously, we're on Zoom call now, and I'm working from home today. So I just wanted to see how we can best use, our home offices for our tax returns this year.
Absolutely. Look, there's always been a claim that's available for working from home. Typically, it's what they call a cents per hour rate, and the government's allowed in the past 52 cents, excuse me, per hour, and that covers essentially depreciation of furniture, power, gas, and all that sort of things. And then in addition to that, you could then claim a percentage of your telephone, internet, as deductions as well. So where this year with COVID as well, because a lot of people may not have those records and not have that data, the ATO has also introduced a special COVID way of claiming work from home, and I believe that's 80 cents an hour, and that will cover the telephone and internet as well. So there are definite deductions available for anyone who has been working from home, which I suspect has been many of us over the last months.
Excellent. It's good to see the ATOs come to the party with that one. I was hoping you could share now with us our special offer to Team Rash clients and see how you can help them.
Oh, absolutely. So for any Team Rash clients, what I'm offering is a 10% discount to what you paid your tax agent last year. So it's a nice little savings. Hopefully put some cash back in your clients' pockets and saving a bit of money. At the same time, I guess it just comes with usual disclaimers that, it's very similar to the previous years, and your circumstances haven't changed substantially. But in any case, please reach out to us. We'll look after you and your clients too, Team Rash.
Thanks, mate. That's awesome. We always love an offer. And I do know a lot of our clients already use you, Marvin. So, and Liquid Tax as a business is great to deal with. So thank you for your support. And thank you for sharing all those tips. We appreciate you joining our call today.
Fantastic. Thanks for your time, Rash. Really appreciate it.
Take care, Marvin.
Thank you. See you.